the automotive regulatory tailwinds are translating into accelerating production. So this is, December quarter was up. This quarter is up 122% on prior quarter. So really very, very strong evidence that is well and truly underway. And that flows through to operating leverage, which drives improving profitability quarter on quarter.
Hello, you're watching Proactive. I'm joined by Seeing Machines CEO Paul McGlone and CFO Martin Ive. Paul, Martin, very good to speak with you. Paul, I'll start with you. Starting with Automotive, Seeing Machines reported record quarterly production volumes of more than 1.28 million vehicles in the third quarter. Can we assume this is driven by OEMs ramping DMS fitments ahead of the July 2026 European GSR deadline?
Yes, thank you very much. Q3 was our record quarter for Automotive. And yes, we are seeing a clear acceleration as OEMs progress their DMS strategy and rollout ahead of the July 26 deadline, which is awesome. We've been waiting for this for a while, and I think this is the first major data point that confirms in a significant way that is happening. And what's encouraging is that it isn't just coming from a single program. We're seeing a combination of existing programs expanding as expected, alongside some of the more recent programs that have gone into starter production, getting to their ramp phase. So we've got kind of a double whammy giving us confidence on the continued acceleration. So the regulatory requirements are now translating into real production schedules with the OEMs, and that's been reflected in our reported volumes in this last quarter. But just for a bit of fun, if you take the 1.28 million vehicles and you were to line them up one after another, they would actually reach from LA to New York City. Or if you want to put it into a UK geography, they would go from the top to the bottom of the UK 4 times. So, if you can imagine that, it's quite a lot of vehicles, and we're super proud that our tech is getting in there.
And do you expect Automotive quarterly production volumes to increase materially from here, or is Q3 more representative of the higher run rate you now expect?
And not at all. We're expecting production volumes to continue to increase quarter on quarter from here, and based on current OEM schedules, additional programs that are continuing to scale, and new programs that we have hitting started production over the next couple of quarters, that will continue to grow from here, which is really positive. So Q3 should be viewed in sort of the way I look at it as an important step change in volume, but it's not the end point. And in fact, it's just kind of a lily pad on the pond on the way to the bigger volume. So as the regulatory tailwind continues to play out through 27, we'll see our volumes continuing to increase. And the Automotive royalty run rate should exceed 2 million units per quarter by June, with the full effect of that in our September KPIs onwards. So, quite a big lift from the 1.28 we're reporting in the last quarter.
Martin, the reported Automotive production volume excludes the minimum guaranteed volumes. Can you explain what these guarantees are, why they're excluded from the KPI, and how they impact the third quarter revenue result?
Sure. The KPI production volume that we report is actual vehicles produced in the quarter that incorporates our DMS and OMS technology. And we present it that way because it's the cleanest operational measure, and it makes quarter-to-quarter comparisons much easier. Separately, for a few Automotive programs, we have minimum guaranteed volume arrangements. Put simply, those guarantees provide a minimum royalty amount period by period. So if actual production in a period is below that guaranteed level, the royalty revenue is effectively topped up to the minimum. Currently, as programs are in that early production and ramping up phase, as we move towards the July 26 European GSR introduction, those guarantees provide some downside protection early in the production cycle. Over time, our expectation is that actual production volumes will exceed those minimums, and then the KPI production metric will be the driver of the royalty revenue along with the ASP. And then for Q3 specifically, we had significant growth in actual production from these programs compared to prior quarters. And the royalty outcome from a revenue perspective was slightly higher than production alone because of the contribution from those minimum guarantees.
Automotive royalty revenue in the third quarter exceeded total automotive royalty revenue for the first half of full year 2026. You also mentioned the expectation of positive adjusted EBITDA in the third quarter and also the second half of 2026. What does that indicate about the operating leverage in the automotive business and the company's path to profitability?
Yes, Q3 really highlights the operating leverage in automotive royalties and how it's contributed to the group achieving positive adjusted EBITDA for the quarter. The step up in royalty volumes has translated to revenue, and that's meant that Q3 royalty revenue exceeded the total royalty revenue we generated in the first half. For profitability, across the whole business, the revenue mix has been shifting towards higher margin, more recurring streams. Automotive royalties are a major contributor to that because the incremental cost of additional volume is extremely low. So as volumes increase, effectively all of the additional revenue flows straight through to gross margin, adjusted EBITDA, and then as cash is collected through to operating cash flow. The royalty increase is a major contributor to having that positive adjusted EBITDA in Q3 and across the second half. In terms of cash, operating cash flow will be positive to Q3. And then in the second half, there will be a normal lag in timing as royalties are invoiced and collected. So the cash flow benefit from the second half will be more pronounced in Q4.
Paul, turning to Guardian and aftermarkets, hardware sales were lower in the third quarter than in the previous quarter, while ARR continued to grow. Can you talk about current quarter momentum and how the fourth quarter pipeline is progressing?
Yeah, look, the Guardian hardware sales are remaining frustrating, to be honest. We have a number of factors that are influencing there. A lot of trials, extended trials, larger companies in the pipeline, more complicated commercial arrangements. Essentially, that's it. We have additional factors today that are brought about by rapidly accelerating fuel prices, putting pressure on transporters. So that's kind of a little bit of a handbrake on decision making. But I think what's important is the annual recurring revenue continued to increase. So as more units are connected, and we enjoy the benefit of the ongoing services. So that's really the key area for us. And it's been increasing reasonably modestly, but increasing nonetheless. So some of the larger fleet deployments have shifted into Q4 due to the reasons that I mentioned. But those opportunities remain active. We're in close dialogue. There's a lot of positivity in our customers for what this technology delivers in terms of risk mitigation. And I expect that to continue. And I do expect to see a far better performance in Q4, given that a lot of the opportunities we were expecting in Q3 have shifted out in their decision making.
I mean, Paul, as you said, Guardian ARR increased to $14.7 million in the third quarter. How should investors think about the balance between hardware sales variability and the growth of recurring higher margin service revenue?
Yeah, well, I think we've got a target to achieve a kind of level rate of hardware sales month on month, quarter on quarter. We're not there yet. That's a fact. So we're seeing this volatility in hardware sales driven by the factors I mentioned. But the ARR is a really positive indicator for business health, and the fact that it's growing, even if it's growing in a relatively modest way, it is consistent. So that reflects new hardware being deployed, being connected, and customers are getting the benefit from the access to the ongoing services. So that's really quite important. Guardian contracts are typically 36 months, some a little longer. So that provides, I guess, increasing revenue visibility on ARR, which is a really solid part of our sort of confidence in revenue performance. So whilst we have this quarter-on-quarter volatility in sales, we expect that to reduce over coming quarters, looking at the pipeline, but we're really focused on delivering the services at the highest margin possible. And of course, in that environment, we have a lot of automation coming into the delivery, which should see incremental margin delivered over the course of this next year.
Martin, can you tell us about the current status of the convertible note refinancing processes and what investors should expect over the next few months?
Sure. Just a bit of a recap. We're running a formal refinancing process with our advisors in relation to what will be approximately $60 million that will be due to Magna in October. And our plan is to refinance that maturity in full through a debt facility. What we've been doing, outreach to the potential lenders has been completed, and we've been in discussions with a number of interested parties over the last couple of weeks. Those discussions have been aided by the strength and the growth profile of our automotive royalty contracts, and the step change that we've seen in Q3 automotive royalty revenue ahead of the July 26 EU GSR regulatory introduction. As we go forward in terms of timing, we're progressing to customary due diligence over the next week or so, and then expect completion before the end of June, subject to the usual approvals and final documentation. But we'll be updating the market each time we reach a key milestone.
Paul, any final comments?
Look, in summary, I think the automotive regulatory tailwinds are translating into accelerating production. So this is, December quarter was up. This quarter is up 122% on prior quarter. So really very, very strong evidence that is well and truly underway. And that flows through into operating leverage, which drives improving profitability quarter on quarter. So really confident of hitting our profit milestone, which is very, very important. Gunnion opportunities, we're continuing to build the recurring revenue base. Although modest growth, we're pleased that's continuing to build. We're working pretty hard to try and reduce the variability in hardware sales, month on month, quarter on quarter. And we have a number of larger programs that have just slipped out into Q4, which hopefully we'll be able to announce before the end of the year. So underlying momentum, I think, is good. Pipeline is certainly very, very strong. So with profitability on track, the refinancing process that Martin's just described, well and truly on track and looking really positive. We believe the group's really well positioned to move through the second half profitable, with long-term debt in place and ready to take advantage of the opportunities that the market presents, whether that be in our current transport verticals and/or new additional verticals brought about by our partners. So really looking pretty confident at this stage.
Well, Paul, Martin, I hope you'll continue to keep us updated with your progress. Thank you very much for your time today.
Thanks for your time.
Thanks, Stephen.
Seeing Machines CEO Paul McGlone and CFO Martin Ive.